Welcome to vTalkInsight, Allocator's Lens Daily for December 5, 2025. Cross-asset markets are walking a tightrope between softening labor data, heavy AI investment, and almost fully priced Fed cuts, all while the S&P 500 hovers near record highs and volatility stays subdued. That mix is forcing allocators to think harder about where the real risks sit beneath the surface, so let's start with what it means for global equities. Equity markets are still trading with a clear risk-on tone, with the S&P 500 holding close to record levels and volatility indices drifting toward the mid-teens. Underneath that calm surface, leadership has started to broaden, as smaller and more cyclical names participate alongside the mega-cap AI complex. The Russell 2000 is pushed to new highs, and recent gains have extended to consumer discretionary, select financials, transports, and European cyclicals such as autos and industrials, while defensive sectors lag. The fundamental backdrop still offers support for this rotation story. Consensus points to S&P 500 earnings growth around the low to mid-teens both for the coming year and for recent quarters, only modestly above typical non-recession periods but enough to underpin incremental gains. Some strategists now forecast index-level earnings nearer 10 to 12%, warning that upside from rate cuts, tax changes, or deregulation may be more limited than in past cycles. At the same time, expected gross share buybacks of roughly $1.4 trillion, with payout ratios broadly stable, could account for a meaningful share of prospective equity returns, potentially in the low double digits. Importantly, those return drivers are no longer confined to a handful of mega caps, as leadership continues to rotate toward cyclicals, small caps, and non-US markets that have already outpaced US benchmarks year to date. AI remains the central narrative for equity investors, but the tone has shifted from pure excitement to a sharper focus on execution and funding. On the positive side, the current AI infrastructure build-out is reported to be delivering revenue growth and cost savings much faster than the early internet era, with companies such as Salesforce and Microsoft highlighting rapid adoption of AI agents and tools, and Meta signaling a pivot of capital toward AI and augmented reality alongside strong top-line growth. Projected AI infrastructure spending of around $3 trillion through 2028, roughly half of it debt-financed, keeps secular growth expectations elevated and supports a broader set of beneficiaries, from semiconductors to industrials and energy. However, mixed earnings evidence and concerns about overbuilding data centers, together with heavy debt issuance by leading technology firms, mean that stock performance is likely to depend more on monetization and profitability than on narratives or partnerships alone. That makes the coming quarters of AI-related earnings delivery, and any signs of slowing demand or capex discipline, crucial for equity risk premia. Against that growth and AI backdrop, valuations are a growing source of tension. Current price-to-earnings multiples, combined with consensus profit forecasts, imply index levels comfortably above 7,000 on the S&P 500, raising questions about how much good news is already priced in. A steeper U.S. yield curve, with 2-year yields still around the mid-4% area and 10-year yields only slightly lower, is seen as a particular headwind for long-duration assets such as secular growth and high-multiple technology stocks. Markets may also be overestimating the number of Fed cuts ahead, given forecasts for U.S. growth above 2%, inflation hovering near 3%, and expectations of further fiscal stimulus and AI-driven capital spending. Layered on top are geopolitical pressures, from ongoing conflict in Ukraine and an uncertain multi-year funding gap, to U.S.-China tech and trade frictions affecting semiconductor exports and European regulatory scrutiny of large platforms like Meta. That combination leaves scope for more volatile equity conditions next year, even if fiscal support and AI investment continue. Positioning does not look euphoric, despite index levels. Fundamentals-focused investors are described as neutral to slightly underweight equities, facing a high wall of worry that includes labor market softness, persistent 3% inflation, and the risk of asset bubbles if liquidity and AI capex fail to deliver durable productivity gains. Some commentary still leans toward a risk-on stance while encouraging close monitoring of froth and inflation, which effectively puts more weight on active risk management than on outright market direction. For allocators, the main watch points now include whether the rotation into small caps and cyclicals proves durable, how Q4 earnings season calibrates expectations for next year, and whether AI-related profits keep pace with the massive capital being deployed. Those equity questions cannot be separated from what happens in rates, where markets have gone all in on a near-term Fed cut. In rates, the central tension is between aggressive easing expectations and still firm inflation and growth data. Markets treat a Fed rate cut at the upcoming meeting as almost a done deal, and many forecasts now extend additional reductions through 2026, helped by weak private payrolls, softer ADP readings, and evidence of job losses among U.S. small businesses. Those data points have fueled a rally at the front end of the Treasury curve, even as mixed signals from jobless claims and challenger reports show a labor market that is softening but not collapsing. Despite the dovish signal from policymakers, the 2-year Treasury yield remains elevated around 4.5%, and 10-year yields sit only modestly lower, leaving the curve inverted but steepening. That pattern suggests investors doubt how far policy rates can fall without clashing with a backdrop of roughly 3% core inflation and forecast U.S. GDP growth above 2%, reinforced by ongoing fiscal expansion and AI-driven capital spending. Longer-dated yields are also carrying a higher term premium, reflecting concerns about fiscal dominance, rising Treasury supply, and questions over Fed independence amid speculation about future leadership changes. Commentary highlighting fears around certain potential chair nominations has coincided with bouts of bond weakness and higher risk premiums on U.S. assets. At the same time, expectations of a shift toward a more supportive balance sheet stance, including steady reinvestment that could absorb on the order of $200 billion of annual Treasury issuance, point to a kind of stealth quantitative easing that might cap yields over time without eliminating volatility. Global policy divergence adds another layer. Speculation that the Bank of Japan could raise its benchmark rate to around 0.75% later this month, alongside very strong demand in recent long-dated Japanese government bond auctions, signals that parts of the world are cautiously moving away from ultra-loose policy just as the Fed edges toward cuts. Some investors report trimming U.S. duration and seeking opportunities in Japan, Australia, and the United Kingdom, where yields are seen as relatively more attractive on a risk-adjusted basis. More broadly, globally diversified fixed-income portfolios are offering yields in the 6 to 7% range, which many see as competitive versus cash and equities, particularly given lingering macro uncertainty. Key watch points now are the delayed PCE inflation release, where core prints near 2.9% could constrain how dovish the Fed sounds, the incoming labor data, and the December policy meetings in Washington and Tokyo. Those outcomes will feed directly into both credit markets and currency moves. Credit still offers attractive income, but the case today is more about clipping coupons than about expecting dramatic spread tightening. Yield prospects for both liquid and private credit are described as compelling into 2026, supported by a base case of growth reacceleration rather than a severe downturn. Globally diversified bond portfolios can lock in mid-single-digit to high single-digit yields, and resilient corporate and household balance sheets are cited as key pillars of stability, arguably more important than the precise policy rate level. Yet spreads, especially in speculative grade, remain tight relative to history, leading some managers to warn against aggressive risk-taking in the lower quality segments. A central development is the credit market's growing exposure to the AI cycle. Highly rated technology companies are issuing substantial volumes of debt, often at attractive spreads in shorter maturities, to finance data centers and AI hardware. This surge in AI-related supply has contributed to somewhat wider spreads over the past few months, even as overall conditions remain benign. Looking ahead, investment-grade new issuance is likely to exceed recent years as firms refinance upcoming maturities, fund renewed merger and acquisition activity, and support capital expenditure in AI, energy, and utilities. The energy and utilities sectors, in particular, are expected to tap markets more heavily to meet the power needs of AI data centers, tying future spread moves to both technology demand and the path of energy prices. Private credit sits at the intersection of these themes, and views are notably divided. Critics argue that the asset class is structurally procyclical, with investor-driven funding that could retreat quickly in a downturn, unlike regulated banks. Supporters counter that long lockups, relatively low leverage, and investor expectations of all-weather allocations make sudden outflows less likely, and they point to improving interest coverage, lower covenant defaults, and realized losses running below historical averages in both the US and Europe. Even so, industry margins are under pressure, with median spreads reportedly compressing toward 500 basis points as competition from banks and other lenders intensifies. The broader AI build-out is also reshaping credit risk. Risk is migrating from data center landlords to hyperscalers and technology operators, and some large banks are actively syndicating or offloading exposure to AI infrastructure loans, while at least one recent data center outage was significant enough to delay a large securitized financing. For allocators, that argues for close attention to issuer-level dispersion, covenants, and the balance between productive capex lending and more speculative structures, especially if growth momentum were to fade. Foreign exchange markets are increasingly central to the cross-asset picture. The US dollar has weakened recently as investors price in more downside risk to policy rates and react to speculation about future Fed leadership, with broad dollar indices slipping to their lowest levels since October and the euro trading around 1.16. Despite that move, there is little sign of panic selling, because the Fed is still viewed as broadly credible, and the labor market, while softer at the margin, has not broken. Nonetheless, many forecasts now embed a structurally weaker dollar path driven by expanding central bank balance sheets and lower U.S. rates over time. A persistently softer dollar would have important implications for inflation and for traditional stock and bond portfolios. Weaker U.S. currency levels, when combined with ongoing fiscal expansion and sizable private sector capex in AI and energy, could help keep inflation nearer 3% rather than at the Fed's 2% target, feeding back into higher long-term yields and potentially reducing the diversification benefits of the classic 60-40 mix. At the same time, currency swings are expected to contribute more meaningfully to overall portfolio returns, especially if markets begin to challenge central banks that appear too dovish or too slow to react to changing data. Episodes of policy doubt, such as concerns about Fed independence or about the appropriateness of future rate cuts, can therefore show up quickly in FX volatility, even if local bond markets remain orderly. Asian currencies are a key part of this story. China's authorities have been setting the daily yuan reference rate weaker than market models would suggest, signaling a desire to curb excessive appreciation, support domestic demand, and manage capital flows in the face of weak consumer confidence and rising unemployment risk. A gradually weakening US dollar gives Beijing more flexibility to allow controlled yuan appreciation over time, which could help attract foreign inflows without destabilizing the export sector. Meanwhile, the prospect of a Bank of Japan rate hike, together with strong demand for long-dated Japanese government bonds, adds to expectations of policy divergence within the developed world and raises the potential for further yen volatility. For globally diversified portfolios, that makes currency management and hedging choices increasingly important as investors rotate some exposure from U.S. Treasuries toward other sovereign markets. Commodities, and industrial metals in particular, sit at the crossroads of trade policy, AI demand, and inflation expectations. Copper prices have surged above $11,500 as traders rush to ship material into the United States ahead of potential import tariffs, creating temporary shortages outside the U.S. and a notable spike in price volatility. Supply is being redirected toward the U.S. market, and commentary highlights the risk of tighter copper availability globally over the next 3 to 6 months. Strategic moves by major miners, including a renewed focus on core commodities such as copper and iron ore and less emphasis on newer segments like lithium, reinforce the perception that copper will remain a critical bottleneck for both traditional growth and the energy transition. Precious metals are telling a slightly different story. Silver staged a strong rally recently but has given back close to 2%, hinting at profit-taking or fading momentum even as broader risk assets hold up. That pullback comes against a backdrop of inflation stabilizing around 3%, some progress on rents and energy costs, and mounting expectations of Fed easing. It suggests that, at least for now, the immediate hedging demand for precious metals may be cooling, even though the medium-term case tied to fiscal expansion and geopolitical uncertainty remains intact. The cross-asset implications of these commodity moves are significant. If copper shortages persist while AI data center construction and electrification projects continue at pace, input costs for manufacturing, infrastructure, and technology hardware could rise, reinforcing demand-side inflation pressures that challenge hopes for rapid disinflation. Higher or more volatile energy prices, driven partly by increased power needs from AI infrastructure and ongoing geopolitical risks, would add another layer. Those dynamics could keep term premia elevated in bond markets and limit how far real yields can fall, acting as a counterweight to aggressive easing narratives. They also reinforce the case for monitoring sector-level equity impacts, particularly in industrials, materials, and energy, where earnings paths are tightly linked to commodity price swings. All of this feeds back into the broader cross-asset balance of risks that allocators are weighing. Stepping back across assets, the picture is one of resilient risk appetite resting on increasingly complex foundations. Equities are near highs with broader participation, supported by solid earnings, large buybacks, and an AI investment cycle that is still in full swing, yet valuations are rich and exposed to both rate expectations and geopolitics. Rates markets are pinned between a front end that believes in rapid Fed easing and a long end held up by fiscal worries, term premia, and the possibility that inflation sticks closer to 3% than to 2%. Credit offers appealing carry but is absorbing a growing wave of AI, energy, and utilities-related issuance, while private credit continues to balance structural strengths against concerns about procyclicality and thinner margins. Currencies reflect a weaker dollar and rising policy divergence, putting FX back at the center of cross-border return management, and commodities, led by copper, are signaling how tariffs and AI demand can quickly translate into inflation risk. Over the coming days, the key watch points are the Fed and Bank of Japan meetings, the delayed PCE inflation data, incoming labor market numbers, and any further escalation in trade or geopolitical tensions that could shift term premia or earnings expectations. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.